Welcome back to EDS, and in this video I'm going to show you how to get big returns on small positions step by step. We're going to be writing options contracts on futures contracts. Okay, now this will work even if you have a small account. If you have a large account, it's even better, but if you're a beginner with a small account, this will help you rapidly grow your account very fast. So the first thing you want to do is open up a watch list with futures contracts that have options available to trade on them. Now, if your broker doesn't have a pre-made watch list giving you this information, then take note of these ticker symbols here and just create your own custom watch list. Now, once you've got that done, you want to order everything from high to low IV rank. And the reason for this is because volatility affects option prices. Now, the higher volatility is, or implied volatility is, or Vega is, then the higher the options price. Because we're going to be writing options contracts, that basically means we are short the contract. Okay, and whenever you're short anything, it means you are selling high and then buying back lower, or you want to try and buy back lower at a later date. And that's how we make profit. Now, when IV is high, it has a high chance of contracting because volatility is mean reverting, which is why we order everything from high to low IV rank. If we are short our options contracts when IV is high, there's a good chance that IV will contract at some point in the near future. Volatility is generally contracting most of the time in the market, and that's going to be good for our P&L. So that's why we do that. And in terms of the actual numbers here, we want to pick an underlying to trade that has an IV rank of at least 30. Anything over 30 is considered high, over 50 is considered very high. So our cutoff point on this watch list at this specific time is at the 2-year treasury note with an IV rank of 30. So anything above this would be good to trade. Now, futures contracts use span margin. Okay, so just to give you an overview, the reason why we use options and the reason why we use futures is because options contracts, specifically writing options contracts, allows us to create a high probability success trade, and futures uses span margin. Okay, and that allows us to be very capital efficient, and that's how we are gonna get high returns by only using a small amount of capital. So you also need to keep in mind that futures are very big products and they have big contract multipliers, and for every underlying it is slightly different. If you have a large account, feel free to just go ahead and pick anything you want. If you have a smaller account, I would personally stick with currencies, for example the euro, the Aussie dollar, Canadian dollar, British pound, and the Japanese yen futures. And the reason for this is because if you notice, the absolute IV level for futures compared to everything else is very low, and IV is taken into account with span margin, and the lower the IV, the less buying power that's required. So with that in mind, just go down the list and see what would fit well inside your portfolio. Let's just say that we go with the euro here. Okay, with an IV rank of 55.5 and an absolute IV level of 8.2%. So then we go over to where we can see a list of expiration dates for that particular underlying. Now on the left side here we have our option expiration dates, and on the right column here these are the futures contracts that correlate to those expiration dates. So February 7th, March 7th is the H5 contract, April 4th, May 9th is the M5 contract, and so on and so forth. Any good broker will automatically display this information here for you in this way or something similar, so you don't really need to worry about it too much. What we want to be focusing on is the options contracts, and the expiration date that we want to pick needs to be between 30 and 60 days out in time. And there's one contract that fits that criteria, or one expiration date that fits that criteria, which is 44 days out in time at the March 7th expiration date. So we're going to open that up, and now we are presented with the options chain. So very quickly, on the left we have calls, on the right we have puts. This horizontal orange bar shows us where the price of the euro futures currently is with respect to the strikes going down the middle here, and we have this vertical orange bar that shows us what the expected move is of the euro over the next 44 days. We have these dotted blue lines that show us our standard deviation levels. We also have delta going along the left and right side here, positive delta on the calls, negative delta on the puts. Now, what we want to do is sell one call and one put. Now, the question is, where do we sell them? Now, we want to have a high probability of success, and in order to have that, we need to understand what it means to actually be writing these contracts. What does that mean in practical terms for our trade? So let's say, for example, if we were to write a contract at 1.02, we want price to stay away from this contract. We don't want price to breach this contract. We want price to stay away from this contract, and we want we want the contract to stay out of the money. Okay, so with that in mind, we know what the expected move is. Okay, so in order to get high probability of success, we simply just write contracts outside of the expected move. Now, the caveat is that the further out we go, the less premium we collect. The higher your probability of success will be, but the less premium you will also collect, and the lower your return on capital will be. So the sweet spot, in my opinion, is in and around the 1 standard deviation level, and that will also line up to a delta figure between 15 and 20. So if we start with the delta, we've got a 17 delta on the call side here at the 1.07 strike, and we've got a 16 delta on the put side at the 1.015 strike. Now, what you'll notice is both contracts sit in and around the 1 standard deviation level. We're between 15 and 20 deltas, and we are outside of the expected move. Now, when you have confluence of all three things, which you always will have, or almost always on every position, every underlying, as long as your deltas are correct, between 15 and 20, it will always turn out to be something like this. And what we've basically done here is created a range for ourselves between 1.015 and 1.07. So as long as price is within this range at expiration in 44 days time, we will keep 100% of the premium that we collect up front. Now, what's the chance of this happening? So if we look in the bottom left corner, we have POP, which is probability of profit. And what probability of profit is the probability of making at least 1 penny on this position. And our POP is currently at 72%. Okay, so straight away we have a 72% chance of success if we want to hold all the way to expiration. However, what if we want to get out of this position at, say, 50% of max profit? Well, we have our P50 here, which is not displayed for futures. However, your P50 is typically going to be about 10 to 15% higher than your POP. So our P50 figure is going to be between about 82 and 87, 88%. Okay, so we've got probabilities of success of between 72 and 88% already. And if you wanted to get out at, say, 25% of max profit, then your probability of success is going to be even higher. But let's just say 85%, just to keep things simple. So that already is a high probability of success. Anything over 50 is considered a high probability trade. So when you're looking at 80+%, it's a very high probability trade. Okay. Now, what about the money? How much money are we going to make on this? So if we look here in the bottom middle, this is our mid price that we would look to try and get filled at if we were going to send this order off, and it's currently sitting at 0.0049. Now, you would have to multiply this out by the contract multiplier. So for equities, the contract multiplier is 100. Every contract controls 100 shares of the underlying. For futures, it's different for every single contract. For currencies in particular, it's in the hundreds of thousands. But don't worry, you don't need to worry about it, because your broker will automatically work all of that out for you. So once you multiply out this mid price here by the contract multiplier, you will arrive at this max profit number. Now, this is in actual real dollar terms. Well, so is the mid price, but in practical terms, this is the number that we'd actually be looking at. So $612.50. That's how much premium that we would collect up front. As soon as this order gets filled, our broker is going to automatically add just over $600 to our cash balance. Okay, and that's non-refundable. No matter what happens, no matter, even if the position moves against us, we will keep that $612 no matter what. Okay, now we will have a buying power requirement of just over $1,260. So we're going to collect $612 up front, and our broker is going to require us to have $1,260 tied up in order to open this position. Now, as you can see, this is already a very high return on capital. We've got very high probabilities of success, and we've got a very high return on capital. So we've got a pop of 72%. So 72% of the time, price is going to land in between our strikes in 44 days time. And when that happens, or if that happens, we keep $612 of premium, which is 100% of the premium that we collect. And if you were to get out, say, P50, 50% of max profit, it'd be 50% of $612.50. That's how that works. We have a daily theta decay of $19.71, which means that assuming all things stay the same and equal, every day we're going to get a positive theta decay of $19.71. So we're basically going to be earning $19.71 every day, assuming all things stay equal. And theta becomes more aggressive as we get closer to expiration. So that number will increase as we go through time, assuming all else stays equal. Now, what if you wanted a higher return? Well, what you can do is be a little bit more aggressive and move your strikes closer to the out-the-money contracts. So if we were to go up to the 22 delta on the call side and up to the 20 delta on the put side, we're still outside the expected move. We're still in and around the 1 standard deviation level, and we're still in and around the 15 to 20 delta range. But if you have a look here, our max profit is now $825 and our buying power requirement is $1,381. This is now a higher return on capital than the position that we were just looking at the 16-17 delta mark. Our probabilities of success have slightly reduced. Our pop is still at 67% and our P50 would still be 10 to 15% higher than that. So we've still got a P50 of say over 80%. But we now have a higher return on capital, and this is because we are now taking more risk because our deltas on the contracts are higher, and our theta figure is higher. And this is simply how you manipulate a position to fit your risk parameters. So the more risk you take, the more your return will be. But the lower your probabilities of success will be. The less risk you take, the higher probabilities of success, the less your return. It's very, everything is sort of in a state of equilibrium. So it just depends on how aggressive you want to be. But for me personally, I like to be in and around the 15 to 20 delta mark. Now, keep in mind these figures are before we make any adjustments. So let's say, for example, if a position moves against us and does breach one of our strikes, we can roll contracts up, down, out in time, and we can sort of manipulate the position to work out in our favor still. So even if a position completely moves against us, given the proper management, we can still get out of that trade at a profit or a break even. Whereas if we did nothing and just left it, we may have had to take a loss. However, if you know how to properly manage your positions and properly make adjustments, you can turn even losing positions into break even or winning positions, or just reduce the size of your loss even. So these figures, as good as they are, it's before you make any adjustments. So in reality, it's actually better than this. And if that wasn't good enough for you, here's another thing to keep in mind, is that implied volatility is generally overstated compared to actual volatility. Okay, so that's going to bump up your probabilities of success even more than what's outlined here. So whether you have a small account, a large account, it doesn't matter. Take advantage of what I'm showing you here. This will help you to rapidly grow your account. Now, you do need to keep in mind your buying power requirement. You want to make sure everything is in check, and in order to figure that out and know what you need to be doing, we've created a free position sizing template here that's available for everyone to use and get a hold of. Link is in the description. Just click on that button and it will take you over to the spreadsheet. The way it works is you enter in the size of your portfolio. So say if you have a $50,000 account, you then enter in whatever the current VIX level is. Everything will then be automatically calculated for you underneath. You just need to then use this information to form the backbone of your portfolio. It will tell you the maximum amount of buying power to allocate to any single defined risk, undefined risk position, how much of your portfolio you should be allocating to short premium strategies in general. It'll tell you the minimum amount of buying power to allocate to undefined risk trades in your portfolio. What we went over today is an example of an undefined risk position or a naked position. And yeah, as long as you follow this, over the long run, you'll be absolutely fine. If you want to learn in more detail about what we do and how we do it, again, click the link in the description, click on EDS Premium, get yourself signed up. Inside, you will have access to our portfolios that allow you to see the positions that we're placing, the adjustments that we're making, how we manage risk, all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It's a private community, so if you do get stuck, you can speak to myself directly or with other like-minded individuals, and there's a 100% money-back guarantee. So once you have studied the full course, followed some of our trades, if after 6 months you're not profitable, then we will work with you for free until you are, or you can simply request a full refund. And so there's no risk. It's completely risk-free for you. And right now it's $9.99 a month. To join, the price will be increasing. However, once you're in, the price is locked in for you for life. So the earlier you get in, the lower your price will be. So you are rewarded for getting in early. And the aim of EDS Premium is to teach you the skill and get you to the point where you are completely self-sufficient. You are not dependent on us. You're not dependent on anyone. You know what to do. You've learned the skill. And once you have learned the skill, it's something that you can take for the rest of your life. No one can ever take it away from you. We aim to get you to a point where you are completely self-sufficient within 6 to 12 months. You're always welcome to stay and be a part of the community, but within 6 to 12 months, you should be good to go. So with that being said, I will see you guys on the inside.